Hello friends and welcome back. Today we are going to talk about a very interesting and a much talked about topic, that is changes in the capital gains that have happened in India. It was much discussed and debated even in the parliament, which forced the finance minister to make some necessary changes relating to capital gain taxation in India. So in this video, I am going to explain to you in detail everything about capital gains and how you can save your entire capital gain taxes. Before we get into the taxation part, we need to understand what is capital gains. Whenever there is profit or gains that arises when you sell a particular capital asset, which could be a residential house property, a plot of land, shares, bonds, gold, a piece of art, drawing, anything that you sell, and if at all there is any gain arising when you sell this particular asset, then it is called capital gains. So now capital gains is classified into two parts. First is short-term capital gains and the other one is long-term capital gains. Why this bifurcation is needed is for the simple reason that short-term capital gains are taxed as per your slab rates. In case if you fall in the 10% bracket or a 15% or a 20% bracket, then short-term capital gains are also taxed accordingly. Whereas long-term capital gains are taxed at the rate of 20% as per the old regime or 12.5% as per the new regime post budget. So now what is short-term capital asset and a long-term capital asset? In case if you hold a property for more than 24 months and then you sell it, then it is called long-term capital asset. And in case if you hold it for a period of less than 24 months, then it is called short-term capital asset, and any gain arising from the sale of a short-term capital asset is called short-term capital gain. So now let us get into the most important part, that is the taxation part, how it is taxed pre-budget and post-budget. So now, as I already said, short-term capital gains are taxed as per your slab rates and there is no option to save any taxes when it comes to short-term capital gains. You will have to pay taxes on short-term capital gains as per your slab rates. Whereas in case of long-term capital gains, there are multiple options to save your capital gains. So first we will understand how capital gains is calculated as such. So to understand in a simple way, let me give you a very simple example. So let us assume that you had bought a property in the year 2000-2001 for rupees 25 lakhs, which is called the base year for cost of inflation index. And now you sell the property in the year 24-25 for rupees 1.7 crores. So there is capital gains on this, and how it is computed. There is a simple formula. So first is the sale value, that is 1.7 crore, and you deduct any selling expenses that you incur on this. Selling expenses, say brokerage or any other selling expenses, say 2 lakh is the brokerage. So you minus or you deduct from 1.7 crore minus 2 lakhs comes to 1.68 crores. So next we have to deduct the cost of acquisition of the property. We had acquired the property or we had purchased the property in the year 2000-2001 for 25 lakh rupees. So what is the current value? So government every year gives a cost of inflation index. For 24-25 the cost of inflation index is 363, whereas for the year 2000-2001 the base year which is considered is rupees 100. So now the computation goes like this. The cost of acquisition is 25 lakhs multiplied by the present year's cost of inflation index, that is 363, divided the base year's cost of inflation index in the year 2000-2001, that is 100 rupees, which works out to 90 lakhs 75,000 rupees is your cost of acquisition, which has to be deducted from your sale price. So the next step is to compute the cost of improvements. Say for simplicity purpose, we'll consider that you had incurred cost of improvements in the year 2000-2001 itself, because the base year, the cost of inflation index is 100. There is separate cost of inflation index in case if you had incurred any other improvements or incurred any other expenditure on the improvements in a later year, say 2006-2007, there is a separate cost of inflation index which you can Google and check. So now let us for simplicity purpose consider that you had incurred rupees 5 lakhs in the year 2000-2001 itself. So the computation goes like this, again the same as for the previous one. 5 lakh into 363 divided by 100 comes to 18 lakh 15,000 rupees. So now the value of capital gains goes like this. So you sell the property for 1.7 crores minus the selling expenses of 2 crores minus the cost of acquisition minus the cost of improvements, which comes to 59 lakh 10,000, and you will have to pay 20% on this in as per your old regime. Now again, as I said, we have two options, as per the old regime and as per the new regime. So now let us compute the capital gain tax as per the new regime. So you sell the property for 1.7 crores minus the selling expenses, the brokerage of 2 crores comes to 1.68 crores. now you do not have the benefit of indexation as per the old regime. That is a very important point to note. So the cost of acquisition in the year 2000-2001 is 25 lakh rupees. You will have to deduct from 1.6 crore, and cost of improvements that have incurred at the rate of 5 lakh rupees in the year 2000-2001. Again, now cost of inflation index, deduct from 1.68 crore minus 25 lakhs minus 5 lakhs. So which comes to 1.38 crore. So now the benefit here is the tax rate, that is 12.5% on 1.38 crores comes to 17.25 lakh rupees. So the difference between the new and the old option is 5,43,000. You will have to shell out more in case if you opt for the new regime. So this option is available for only resident individuals and HUFs. You do not have the option in case if you are a non-resident individual. So it is bad news for non-resident individuals, NRIs. You will have to choose only the new option. So now in case if you buy the property post 23rd July 2024, you will have no option to choose the old regime. You will have to go with the new regime itself and pay a tax at the rate of 12.5% on the capital gains. So now let us move into the most important part, that is how to save taxes and what are the options that we have. The first option is to pay, of course, to pay taxes at the rate of 12.5% or 20%, and the second option, the second most important option that we have is we can invest in capital gain bonds to the tune of rupees 50 lakhs. In a financial year, maximum amount that can be invested is 50 lakh rupees. These bonds are the bonds of NHAI bonds, REC bonds, that is Rural Electrical Corporation bonds, and the third one is Power Finance Corporation bonds. We will get an interest of somewhere around 5.5 to 5.75%. The interest is taxable, but we have a lock-in period of 5 years. So now the third option is section 54, that is reinvestment in a new residential house property. So as per our discussion that we made, let us assume that we had sold the residential house property itself. Only then section 54 is applicable. Whereas in case if you sell a plot of land or a commercial property or listed securities, then section 54F is applicable, which we will discuss in a separate video. So in this video, we are going to discuss only on sale of a residential property and section 54, which is applicable when you reinvest the entire capital gains in a new residential house property. So in case if you invest the entire capital gains in a new residential house property, then your entire capital gains is not taxed. Say you have a capital gains around 40 lakh rupees, you invest in a new residential house property, say for around 60 lakhs, 70 lakhs or even to the tune of 1 crore, then your entire capital gains is not taxed at all. So the time limit for reinvestment is 1 year prior before the sale or 2 years after the sale. So in case if you have invested in the house property 1 year prior to the date of sale, then there is absolutely no problem. While filing your ITR, you can claim that you have already invested in the property and you can claim the exemption under section 54. So now in case if you could not reinvest in a residential house property before filing the returns for the said period, then you have an option to park your funds in a capital gain account scheme. So what is capital gain account scheme is basically it is like a savings bank account you can open in any of the nationalized bank account, and then while filing your returns you can claim that you have invested in capital gain accounts and your intention is to invest or reinvest in the residential house property within a period of 2 years. So now the most important part is that we have two options, section 54 EC and capital gain account scheme, that is reinvestment in a new house property. These two options are available both in case of old regime as well as in case of new regime. Absolutely there is no change to it. We can invest in 54 EC or capital gain accounts. So friends, this is a very simple understanding on how capital gain works in India and what are the changes made and what are the options that are available to us post budget and what options that we need to choose in case if we choose the old regime and the new regime. So friends, I hope this video has been very helpful to you, and in case if you have any questions on this particular video, definitely you can post your comments below and I'll happy to answer them. Thank you very much for watching. See you in the next video.